Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Morningstar's Dan Kemp. Hello, Dan.
Hello.
So I have been speaking to a number of income investors, income professional investors over the last couple of months, fund managers who run multi-asset portfolios, fund managers who run bond portfolios, and they've been telling me that what is in their fund looks very different now than it did 5 years ago.
Well, yes, I'd agree with that. And I think that's one of the difficult things for investors, the end investor, who are trying to generate an income from their portfolio. Whether they're in retirement or they need an income for something else, then just using funds with the income moniker means that you may get something very different in your portfolio from what you've had in the past. And people need to be very careful about what's inside their portfolio, how their fund manager is generating that income, and really what risk they're taking.
Because income, of course, remains the #1 goal for so many investors. It's not just for those in retirement who are looking for an income, because we all know the accumulative effect of income units leads to growth. It's a great way to sort of maximise your growth as well. So we can't just say, you know what, that looks too risky for me, I'm not going to invest, because income is so hard to come by.
It is hard to come by, but also you have to be careful about how much you're paying for that income stream. And in the current environment, where we see interest rates incredibly low, then equally the yield on risky assets is also quite low. And so that implies that the price is high, and it may be that you're paying far too much for risky assets in order to get that yield. And certainly you need to be careful about paying for yield from safe assets, because that's very low and in many cases looks very expensive.
Because it's that dual factor, isn't it? We've both had bond yields come down, and that's across the board. That's not just with gilts. So we see high yield bonds maybe not living up to their name as much as they should. And on the other hand, equities that produce a regular income that have become known as bond proxies and have become extremely expensive. So finding the right income at the right price no longer looks like it did 5 years ago.
No, that's right. And we've done quite a lot of analysis of income-generating funds, both in the UK equity income sector and the overseas equity income categories. And what we've seen is that gradually the price you're paying for this income yield has been increasing over the last few years. So you're getting the same in terms of yield, but you're paying more for it. In effect, the cost of that yield is going up, which really means that the risk typically of that yield is going up. And I think one of the things that we're concerned about for income investors is that as they allow the risk in their portfolio to increase, but without the income increasing, then they just make themselves more vulnerable to disappointments.
And so what should we do? Is it a case of accepting that this is the new norm?
No, you should never accept things in investment. All the best investors will tell you that you look for the great opportunities. You don't just invest in whatever market conditions come along. And you make sure that you invest for the long term rather than just trying to grab the income that's available now. And so I think investors need to be very clear about what they're holding, how much they're paying for that income stream, how much their fund managers are paying for that income stream, and be very selective in working at how you're going to put your capital to work. So we're not living in the same world we were 6 or 7 years ago, where you could get a high yield from so many different types of investment. It's now much more selective. And be very careful about the promises you're accepting, whether it's promises from high yield bonds that may not be as credit worthy as you'd want them to be, or promises of rising dividend yields for companies that may not be able to sustain this in the future. Be very careful about what you have in your portfolio.
Dan, thank you very much. This is Emma Wall from Morningstar. Thank you for watching.